Now more than ever, transportation business owners need industry experts at every stage in their company's life cycle. We bring them to you in the hot seat.
Welcome to In the Hot Seat with the Tenney Group. I'm Spencer Tenney. It's good to be with you. Today, we got a good one. We've got Peter Lee from First Bank. He's going to share some expertise as it relates to banking and the transportation industry. Peter?
Spencer?
Welcome to the Hot Seat.
Thank you very much.
Before we get going here, real quick, can you share with us just brief overview, who you are, what you do?
Sure. Spencer, I'm Peter Lee, and I'm with First Bank here in Nashville, our corporate banking group, and I'm a senior vice president and senior relationship manager.
Excellent. You ready to jump right in?
Sure.
Let's get to it. All right, first question. A lot of activity out there in the markets right now. What happens to trucking companies when interest rates rise?
So, in the event of the interest rate rise, obviously, there has been since, mid-2018, federal government, Fed Reserve really has, increased the rates as a result of a robust economy that we're having. Mm-hmm. So, for my understanding is that in 2019 they're predicting 3 more interest rate. Mm-hmm. So it's always we've had, as far as financing goes, we've had interest rates that are very attractive as a result of the lower rate. Mm-hmm. As the interest rate continues to rise, obviously our trucking company will face with higher interest rate for financing their trucks and trailers and so on and so forth. So it's been more of using a short-term interest rate instrument to finance trucks in the past for let's call it last 10 years.
Okay.
Now the rate is going up, therefore they should think about a new strategy, including a fixed rate going forward. And so that predictability is what is key here.
So Peter, you know what I do.
Yep.
In terms of working in the acquisition and the business sale world, when these trucking companies, I find there's a lot of confusion when they go out to finance growth through acquisitions as far as what does that banking relationship look like. So can you share with our network, what should they expect in terms of how you go about evaluating whether or not they're going to be capable of getting the financing? And then, once you decide that you want it, what do you typically extend to them in terms of credit to finance the deal? Right.
So, historically, obviously, we want to have companies that have performed well, right? Mm-hmm. That's just a fundamental, right? That's just basic fundamental. From there, we do want to see exactly what is the purpose of the acquisition, how that fit within their strategy, okay?
Yeah.
And therefore, we want to know what the potential buying will help them enhance their going forward as far as their profitability, but also growth and so on and so forth. So more specifically, the banks are looking for, of course, solid management team, number one.
Amen.
Yeah, because you can have all the tools in the world. If you don't have the people leadership, then you're taking a big risk, in my opinion. Mm-hmm. The other thing, again, going back to fundamentals of historical performance, both good times and particularly the bad times. How did they evolve out of the bad times, which we have a cycle within our trucking industry, as you know. And so that really speaks aloud, and it really provides us with a lot of assurance that they can pull themselves out of the low point as well. That's key. Thirdly, of course, we want to see consistent, not just profitability, but free cash flow.
Okay.
That's the key.
So let's hear your definition of free cash flow.
Sure. So basically, it's cash that is available to pay me back. Right?
Like I said, there's some confusion about why that might matter. Well, let me heat it up a little bit. You mentioned lend more, so let's quantify that. Okay. What should they? Let's put like a number, round number, $100 million total consideration for a deal. Mm-hmm. What percent of that total consideration should a buyer expect to attain from a third-party lending source like yourself? For the senior debt.
Senior debt. What we call it 3x4, which is 3 times leverage on the senior, total leverage of 4. But times like this,
3 to 4 times what?
Oh, EBITDA.
There you go.
Thank you.
So let's just say the purchase price was based on a multiple of 5.
Okay.
We got max leverage at 4. So what that means we got one more turn of EBITDA to deal with to get to the purchase price. Where's that going to come from?
Well, it could come from, the owner financing or seller financing, right? Or you can go outside the bank market and use the what I call it, mezz or second lien or whatever.
Are you when you calculate the total leverage as part of that 4 multiple? Do you include the mezzanine and the seller financing as part of that calculation?
You do.
So so if that's true, then will we need some equity to kind of get the rest rounded out?
That's right.
Okay.
Yeah, that's correct.
Excellent.
Yeah.
So what would be the difference in terms of a typical rate for acquisition financing for the senior debt versus the mezzanine debt?
Yeah. Depends on the credit, the strength of the credit, overall.
Right.
We don't have to go into details, but I would say probably, traditional bank debt could be anywhere from 2.5% to 4%.
Okay.
Versus, these non-bank deal could be anywhere from, call it 7 to 10%,
Or more. Yeah.
Or more.
Yeah. You've been doing this for 28 years. You've accumulated a lot of knowledge, but I'm curious. You go back in time 28 years, and you take banking off the table. Where do you think you would have ended up professionally?
Oh, wow. That's a good question. Actually, I was trying to. I love history and I love political science, and I wanted to become an analyst for CIA.
Interesting.
Yeah. So that would have been something that I tried, but I couldn't go beyond basically all the way through the process.
There's still time. Hey, thanks for being in the hot seat, Peter Lee. Hey, thanks for joining us. I'm Spencer Tanning. Until next time, we'll see you then.